Welcome to Hedge Fund Tips with Tom Hayes. This is VideoCast number 42 and podcast episode 32 for the week ending August 7th, 2020. And as we do each week, I'd like to start off with the media spots. First, I'd like to thank Liz Clayman and Ellie Terrett for having me on the show this week. And incredible story. Literally 30 minutes before the show started, I was up in Connecticut working remotely. We lost power, cable, the whole shebang. Generator was certainly of no assistance, so we did a cell phone call in. We're going to talk about some of the important subjects we covered. And the most important thing that Liz asked, which was a great question, if you had to rotate out of tech, into what sector or sectors would you rotate into? And it was very prescient. We saw it today, a big move into cyclicals and a lot of money coming out of tech. So the timing, as always, with the Clayman Countdown was spot on for her viewers. Thank you to Liz Clayman and Ellie Terrett for having me on the show. And now we're going to move to the BBC World I was on Wednesday. And the key question that was asked there, that was Sharonjeet Leal. And thank you to Katie Silver, the producer who invited me on. And Sharonjeet was asking, why is the market up so much? And we're going to go into that in quite a bit of detail. So that was fun to be on BBC World News with Sharonjeet. Thank you for that. And now let's get right to our article of the week. We called it the Garth Brooks Friends in Low Places Stock Market. That's actually last week's. Now we're going to go to Tim McGraw's. A lot of country themes here. This week was Tim McGraw. I like it. I love it. Stock market and sentiment results. And I always get nervous putting a title like that, you know, as the market's moved up, because very easy to top tick when you put a note like that out. But as we described it, that's basically the theme over the last week. The market's been going up, and I thought that I like it, I love it, I want some more of it. I try so hard, I can't rise above it. And we're going to talk about that now. So basically, we have finally filled the gap from late February that we had talked about in recent weeks on the S&P 500. And now the question is whether or not the S&P has enough gas in the tank to rise above it, as Tim McGraw would say, and make new highs. And we're going to find out in coming weeks. You know, definitely the stimulus package is very important. They seem to be going back and forth, but we've said literally for the last 2 weeks that we didn't expect the stimulus bill to get passed. That was not our base case. What we expected was executive orders. I don't know that they're going to get. It's a wide chasm that they're trying to bridge between 3.5 trillion, 3.4 trillion, and 1 trillion. Number one, there are a number of nuanced issues with regard to vote by mail and money for states. That I just don't know if they're going to get there. And the most important thing is that they extend the unemployment benefits, which maybe we'll get an announcement for over the weekend or tonight. I'm recording this at about 4:55 p.m. on Friday. That's number one. The eviction and foreclosure moratorium, that can get done by executive order. And third, maybe the stimulus checks. There have been a lot of talk about a second round of the $1,200 checks for lower-income households. That's a huge, huge benefit. And whether or not the administration can do all of those by executive order under emergency powers remains to be seen. But I do think we're going to find out. And we've been talking about it for a couple weeks. Charlie Gasparino and his partner Lydia over at Fox Business have been publishing early scoops on that type of action. And my sense is this. I mean, if I was in this administration's shoes and I was having difficulty coming to a deal and I had re-election coming up in November, I would effectively preempt it. And I would just say that My opposing party does not want to come to the table to come up with something urgent to carve out the people who need it most. So we're doing this executive order and then just fight it in court later and take credit for the stimulus. That's what any logical, whether it was a Democrat or a Republican, would do in such an urgent situation where people are week to week with the enhanced unemployment. And to quabble over whether it's $600 a week or $200 a week. I said 2 weeks ago on CGTN America with Mike Walter that they'd meet in the middle. It looks like that's the direction that they're going, but the question is all the fat around the stimulus. I don't know if they're going to get to a deal, and it seems like the Democrats don't want to do a carve-out because then all the other stuff would be off the table. And fundamentally, at this stage, with the way the economy is recovering and all of the unused stimulus from the first bill that's authorized and able to be used but hasn't been drawn upon as of yet, what is needed, which is the enhanced unemployment and potentially the stimulus checks and the eviction and foreclosure moratorium, if that can all be done from the executive branch, which we've talked about in recent weeks, then there's no reason to do a deal before the election, and the administration could effectively take 100% of credit for getting people what they needed in a time of need, and then fight with it later if it was a potential constitutional or legal issue. I'm sure they vetted this. I think the payroll tax cut is something that could be done from the executive branch. I don't know optically if that would make sense. It certainly would help put people back to work. But we have somewhere now in the last 3-4 months recovered just over 40% of the jobs that were lost from COVID have now been recovered in just the first 3.5, 4 months following the crisis. That is staggering. We saw some numbers today, which we'll get into. So there's a lot of things that point to getting the gas to get over all-time highs for the S&P 500 as we had with the NASDAQ, and then potentially for the Dow. Small cap showed some strength today. So there's a lot of good things happening, and that's the next step. So, it looks up here, 3393, 3400. The other thing is earnings support it, which we'll also get into. Analysts have actually been taking estimates up. So estimates for 2021 are now higher than they came in for 2019. So we already got to about 3,400 on the S&P with slightly less earnings than we're going to have on a go-forward basis. So it would support making all-time highs just on fundamentals that are coming in. So that's a good thing. Last week and in many recent weeks, we've emphasized the relative performance between leaders and laggards. And in the Garth Brooks article last week, which we brought up a minute ago, we said we wanted to make some friends in low places by focusing on those cyclical value laggard sectors that we believe are going to outperform in the early stages of the recovery. And you can review that note here at the website, the Garth Brooks Friends in Low Places Stock Market. Either you can find it, the easiest way to find it is you can always just click on under categories here on the right at hedgefundtips.com, click on sentiment, and or use this search bar here on the right and type in Garth Brooks and it'll come up. So Liz asked the $1 million question, and this was the call in on Tuesday, and she said, with a huge run in tech, if you had to rotate into another sector, what would it be? And I said I'd follow Warren Buffett into banks. In the past couple of weeks, he's purchased now over $2 billion of Bank of America stock. He's also applied, he now is authorized to buy up to 25% of the bank without becoming a bank holding company. And this has taken his total position to $25 billion. Wells Fargo is also one of his top holdings. So it's times like this, which we linked to a couple articles last week when everyone's was asking when he sold airlines at the bottom in March, is Warren Buffett losing his touch because he's now buying cheap laggard value stocks instead of buying the high flyers. These are the periods that have always preceded his largest periods of outperformance historically. If you look back over the last 50 years, when he's lagging, like in the late 2000s, he was buying value stocks when they were out of favor, and then the tech market crashed and the value stocks outperformed over the next 8 years. He outperformed, we covered it, I think, a couple weeks ago by about 250%. If you added in the tech loss relative to tech, it was somewhere over 300 some odd percent, and just completely crushed it. And the same thing is going to happen right now. No one wants banks. No one wants financials. Warren Buffett is buying them hand over fist. And, by the way, we talked about it in recent weeks, but that he had bought back about $5 billion of Berkshire, which is obviously financial, in the financial, one of the top weights of the financial sector in the S&P 500. Now they're estimating, there was an article on Bloomberg, that it's closer to $6 billion of stock that he bought, and that's why you've also seen Berkshire stock flying. So that's just another factor. He has not lost his touch, and he will prove the naysayers wrong once again. He's done two $10 billion deals in the energy industry in the last 12 months. Everyone thinks those are silly. Over the next 5 years, you're going to see they're the most brilliant bets he's ever made in his career. Well, they're gonna make him a lot of money. I mean, he's made a lot of brilliant bets, so I can't quite parse it that way. But and now loading up on banks and loading up on his own stock, which is a phenomenal opportunity. Okay, so never ever bet against Warren Buffett, and the time to bet with him is when everyone's questioning him, because he's always doing what's unpopular and buying inefficiently priced stocks, which is what's made him able to outperform over many, many decades. So the other thing I elaborated on with Liz on the Clayman Countdown on Fox Business was that since Wells Fargo's now cleaned house management, all of management that was involved in the aggressive sales practices is gone as of a couple of weeks ago when the CFO stepped down. So now they can go back to the bank regulators and say that, you know, we've changed our policies, we've changed our management, please remove the asset cap, the $1.95 trillion asset cap, which has limited its growth. And knowing that this is a pro-growth, pro-recovery, you know, yes, they've done the miracle of getting 42% of the jobs back in just a few months, but they want the other 58% of the jobs back. There's no other way to do it than to increase credit growth and credit expansion. And Wells Fargo is the largest, one of the largest mortgage lenders and small business lenders in the country. They are a transmission mechanism to extend credit and grow credit, which is critical. You cannot have a recovery without credit growth. And Wells Fargo is one of the biggest players, and it has this governor on its ability to help the U.S. recover, to help put, we've got 9 million of the 22 million jobs back, but to get those other 13 million people back to work, you need Wells Fargo out there extending credit along with the other banks. But the consumer, Wells Fargo is the most consumer-facing bank. You know, you got certainly J.P. Morgan. Bank of America is probably the second best, or if not the best. That's why Warren Buffett is heavily weighted. You notice Warren Buffett has Wells Fargo and Bank of America. He doesn't have a lot of Goldman Sachs. He doesn't buy he doesn't have the investment banking and trading unpredictable revenues. He has the steady mortgage business, small business lending, consumer lending in this case. And I think that if you're a bank regulator and Wells Fargo says we've made all the changes, we need you to lift the cap. You need us to put all these people back to work. Yes, you've done it, almost half of it now on your own, but we can help accelerate that and really, get Main Street back to work. I think it's a win-win. I think that could be one of the major catalysts to moving forward. It's still trading at today it was up 3.5%, but it's still trading at about a 35% discount to book relative to a 75% premium to book. It traded at just a few years ago. Last time they cut the dividend on March 6, 2009. The stock went up 250% over the next few months. Book value is around $40 right now. It wouldn't be unrealistic to see this thing trade back up to book, over the next handful of months, if not more. And if you get a lucky break, which would be great for the country, for the recovery, where the regulators say we have no reasons to keep this cap over them because they've made all the changes, and we need them as a transmission mechanism for the recovery, this thing could just rocket overnight. So that, coupled with getting closer and closer to the vaccine and or treatment, which Goldman Sachs put out a note in the last 24 hours that was reprinted on MarketWatch through Steve Goldstein. And basically what they're saying is what we've been talking about in recent weeks, that, theirs is more pronounced. Tech stock leadership could be in jeopardy from successful vaccine news. And so they're talking about the rotation and into cyclicals once it's clear that the recovery is going to be here, because cyclicals always outperform in the early stages of recoveries coming out of recessions, because they do well in high growth environments, and when the bar is very low, it can jump over it. And tech does well in slower growth environments, later stages. So that's number one. Number two, they put a shocking $3,700 target on the S&P 500. So it wasn't just saying like, okay, go into cyclicals, tech is going to weaken. It was like this market could blast to 3,700 because, people know there are a lot of shots on goal, but this could happen a lot quicker than people are anticipating. Like they're talking early October, and then you'd have a vaccine, getting out there in early November. I don't think anyone's really aggressively looking at that. And he's saying it could just shock people and take the market to 3,700. Maybe, maybe not, but I thought that was certainly very interesting and in line with what we've been talking about in the last handful of webcast, videocasts. The other thing, so that's about our favorite stock, Wells Fargo. We added pretty materially this week to it for clients and for ourselves. And we like it. So let's see what happens. Next, the other thing that I think is more important than that is looking at the earnings expectations for 2021 that really support the theme of a rotation or an outperformance of industrials relative to tech. I'm not of this binary zero-sum game like tech will crash and cyclicals will rally. I don't see it that binary. I see it as tech should generally do fine. They're effectively monopolies, the top five. We know that. Maybe there will be regulatory challenges for them because of that, but it'll be tough to prove and it'll drag out. But, the one thing I can say is I've rarely seen a company go before the Senate on antitrust issues and things got better for them in the intermediate term. Usually, even if they get through the first hearing or whatever, it's the beginning of, a heavy lift for many years to come. And if you want to ask people how that works, just ask Microsoft and, how it took them many, many years to recover from the government heavy hand. And in effect, they missed mobile because they were so, overweight dealing with antitrust and dealing with the government that they missed that. And now Satya's in the driver's seat and they're back, and they missed mobile, but they got SaaS effectively with Office 365 and completely transformed the company. So kudos to them. So there are a number of things, but the most important thing that I see in the short term, because we're looking here at the intermediate term, we want to know what's going to happen in the next 3 to 9 to 12 months. And estimates for 2021, the S&P is expected to grow earnings 29.2%. That is relative to tech, expected to have earnings growth of only 14.3%. So analysts are saying we squeezed a lot of juice out of the lemon. They got obviously a boost from everyone being forced to work remotely in Q2 of this year. and we saw that in blowout earnings for them, for FANG, in recent weeks. And however, you've got Infotech at 14.3% growth, S&P at 29.2%, but financials are expected to grow earnings at 31.6%, and industrials at 85.5%. Again, these are off low bars, but when you have those type of growth rates, it's an excuse for re-rating, multiple expansion, rotation, capital flows, all the positive things that cause a sector rally. And that's, that's been my kind of career in knitting, is catching sector rotation and then trying to identify those stocks within the sector, skating to where the puck's going, that I think are going to have the best relative to performance. So the sector relative performance and then the stock relative performance. And that's just, that's what I do. That's what I like to do. And hopefully you're finding some of this valuable that you can benefit from it. So next, the other thing Liz asked was, what other sectors, and I didn't get a chance to talk about all of it because the signal wasn't the greatest. Cell towers were down, landlines were down, power was down. It was awesome. But anyway, we also like defense stocks quite a bit, some energy, and home builders. Now, home builders, and all of these we've been buying. Those of you who've been following us know, since the crash in March and April, home builders have already had a monster move. That is going to continue for years to come. But, obviously when they're trading at new highs, they've had a lot of the short-term moves. So, you look for some weakness on that in coming months to add for the longer term. And that's a function of 85 million millennials, now urban flight, and the housing formation for 85 million millennials was starting well before COVID. It's dramatically accelerated it. You're having bidding wars in Connecticut, which has been in a housing depression since 2008. One of the few states that just, houses were still trading at a discount to 2007 levels 13 years later. That's now changing, and you're seeing bidding wars, which is mind-boggling. And bidding wars even an hour out of the city, because now people, bosses believe, can see that people can work remotely and they maybe only have to go into the office once a week or 2 or 3 times versus 5 times, and that enables people to get more house and land for less money, and they're doing it. So, so defense stocks in particular, and it was interesting. I wasn't going to spend a lot of time on it because it's usually a short segment. But with the rhetoric escalating with China, it's going to, if for nothing else, it's going to draw attention to the low valuations. It's in the industrials basket, which we just covered, is going to have among the highest earnings growth for 2021, along with consumer discretionary and energy. And so you're going to have a situation where money's going to be rotating. Rhetoric is going to pick up. And the one thing that I've always said, a couple weeks ago I was on with Mike Walter on CGTN America, and I said, so long as the phase 1 deal stays intact, I don't anticipate this escalating to anything beyond, rhetoric. What we found in recent days is that the Chinese are well behind on their energy purchases for 2021, and they're going to be having a meeting with the administration in coming weeks to discuss that. But with them so far behind on their purchases, I think more and more attention is going to draw into these defense and aerospace sector. And the other thing was, there was a note that actually came out today which supported this thesis, but it wasn't related to the kind of Cold War, trade war escalation with China. It was more related to actually government demand for the space-based programs. For those of you who've been watching Space Force on Netflix with Steve Carell, that there will be tremendous demand. And, by the way, we have a new branch of the defense sector. So, what Michael Eisen says in his RBC research note via 24/7 Wall Street, which was posted today, he says, quote, defense exposure continues to provide a more stable fundamental backdrop. Investor concerns regarding the outlook for defense budgets has weighed on the sector's valuation, which we think has been overstated. The group has appreciated on average by 4% over the last 3 months versus 16% for the S&P 500. Earnings results from the defense contractors have all held in much better than feared, delivering headline beats for all companies with the majority of sales to the end market. Book-to-bill ratios have also held above 1 times across the board, with the strongest backlog growth coming from space-based programs. That was not part of my original thesis, and that is a nice added benefit. So I'm going to have to parse those numbers over the weekend and coming weeks and see just how material that is. And he said, in contrast, the outlook for commercial demand has turned more bleak as the spread of COVID-19 continues to trend in the wrong direction. Okay, so I would disagree with that last statement, and we'll show the data that supports it. But he's calling this mega cap defense stocks may be the best idea for the rest of 2020. So there's an ETF for that. You can get a basket. I think it's ITA is a basket. Or he's recommending Boeing, General Dynamics, and I think he had Raytheon, L3 Harris, and Raytheon. So the big names that would be the highest weights in an ETF anyway. So that was that. And also, Liz referenced a Morgan Stanley note by Mike Wilson, who I read a lot, that was not only calling for a rotation into cyclicals, but also a 10% correction in the overall market, before resuming the V-shaped recovery. This is certainly plausible, but whether the market corrects a full 10% as they predict or not is going to be dependent upon how aggressively value and cyclicals pick up the leadership role as we get better COVID, vaccine treatment data in coming weeks and months. And we're getting good news every single day, and I think we're going to finally get a hit sooner than we all expected. I think it's going to be a big surprise, like a light switch. Money's going to move into cyclicals. Now, the skeptics will say, well, the weight of, the cyclicals is so small relative to tech and healthcare that you would get a major correction in the market if you had an abrupt rotation. And to that I say, you could either see a flattening market, you could certainly see a 5 or 10% pullback, but under the surface you would have other different stocks and sectors rallying while the market is taking a breather. And we're seeing this show up actually in the correlation of stocks has widened, meaning you're getting paid more today for being able to pick stocks than you have at any point in recent history, where it was like risk on, risk off, everything trades together. Now there's such a wide dispersion of stock performance that if you can anticipate these moves and skate to where the puck's going and then get the best stocks within those sectors, you can dramatically outperform. And it's just the environment that the market has served up. Oftentimes, that is the type of environment you see at periods of inflection, not only of economic recovery after recession, but oftentimes it precedes a change in rate environment. So a lot of the best stock pickers, billionaire stock pickers, mostly value guys, who made their fortunes in the 70s and late 60s, full 70s, early 80s, when the market was even flat, but rates were rising. That's when value tends to outperform, and that's where stock pickers really get paid. So the billionaires like Lee Cooperman, Mario Gabelli, and that whole crew, obviously Warren Buffett dramatically outperformed in the 70s. They made all their money in that type of environment, a rising rate environment or an inflecting rate environment. That's when, like I said, the correlation goes down and stock pickers can really dramatically outperform. It's very hard for stock pickers to outperform when the correlation is so tight and you're just playing the risk on, risk off game. And that is changing. So that may foreshadow a change in the rate regime. Not that rates are going to spike up overnight, but they could potentially, we could be at an inflection where they start to move in a different direction. And certainly steepening is in the cards if yield curve control comes to pass, because this Fed is focused on the short end of the curve up to the 5-year, which would steepen it dramatically and pour buckets of profits into banks, and that would transmit to Main Street because it represents lending and profitability in lending, which incentivizes the extension of credit, which incentivizes the transmission mechanism, which hopefully the regulators get the point and take the asset cap off of Wells Fargo. Okay, moving on to the next section. I also got a email from Moxie Ying at Bloomberg this week. She's working on an article. I don't know if it posted yet or not, but she was talking about the weakness in the dollar and the implications of that, and how it made me think about investing moving forward. The good news is the dollar has weakened, and that'll help S&P earnings, that'll help emerging markets, that'll help currencies. The bad news is usually when I get an email like that, it's at the end of a short-term move, so probably expect a little bounce in the dollar in coming weeks. But I think the trend is right. And what's interesting is about 2 or 3 months ago in one of these podcasts, I noted a stat from one of the Bank of America Global Fund Manager survey that managers, I think this was probably the February report, were the most bearish on the dollar that they had been since like 2002 or 2003, and the dollar subsequently plummeted like 40-50%. Emerging markets just took off, value stocks took off, commodities took off, and I think that we're in a similar situation. So I put her questions in bold here in the article. She said, how big important are currency plays when you're investing in equities? How does a weakening dollar affect your investment? So certainly it's favorable for emerging markets and commodities. It attracts foreign investment, and it makes it easier for emerging market companies to service their U.S. denominated debt. And they took out a lot of it in this cycle, so that's going to really, really help them. Also, it's estimated that about mid 40%, depending on the year, 42.5% to 47.5% of revenues for the S&P 500 come from overseas. And a weakening dollar is going to help those S&P earnings as the foreign currency received converts back to more U.S. dollar and improves EPS. Also makes multinationals and U.S. exporters much more competitive in foreign markets. It's a tailwind to U.S. earnings. It can be a headwind to the U.S. consumer, particularly. They lose a bit of their purchasing power because commodity prices go up, like oil and gas, and the prices that they have to pay for imports, etc. So the sectors that benefit, tech to a lesser extent, they're more insulated from this, but they do have as much as 60% of revenues from overseas, so that can be helpful. Industrials do very well in that environment. Staples do not do well because their input costs go up. Materials and energy do well because what they're selling becomes more valuable. And financials benefit because it's usually, when you see a weaker dollar, you start to see a steepening of the yield curve. So that helps net interest margin for banks, incentivizes lending. Healthcare, utilities, and real estate and telecom do not generally benefit because they have a lot of U.S. sales. And her last question was, are currencies becoming increasingly important determinant of what stocks you buy and why? What's your thinking and philosophy behind this? Generally, yes and no. It's not a factor, but the sectors that I'm leaning into will benefit from this. I'm not leaning into those sectors because I'm predicting the dollar. I'm leaning into the sectors, and those sectors happen to be benefited by a weak dollar. So it's a second derivative. It's not a primary line of thinking. But what I did include in the article is a chart of emerging markets relative to the dollar. And as you can see, when the dollar bottoms, the emerging markets peak, and vice versa. When the dollar peaks, the emerging markets bottom. So you saw a peak in the dollar in 2009. The emerging markets had crashed. You saw a peak in the dollar in this 2015 to 2016 2016 period, the emerging markets crashed. And then as it started to weaken, you had a huge rally in the emerging markets, both in 2003 to 2008, in 2009 to 2011, and in 2016 to 2018. And now you had your dollar peak in the early 2020 when emerging markets crashed. And now that the dollar is weakening, emerging markets are ripping off the bottom. So the same is true with commodities. It's basically the same because the correlation between emerging markets performance and commodity performance is so high, but it's effectively the same. Weak dollar, strong commodity prices, strong dollar, weak commodity prices, etc. And that's the reason for why those sectors do well. Now, on the BBC News, World News with Sharanjit Leal, they were curious, like, why is the stock market doing well? And they were focused on, like, oh, cases are going up and COVID is so bad and everything else. And yes, it is. You don't want to diminish that. But cases are coming down slowly and stubbornly. But in the spike areas, the Sun Belt, they are coming down. Arizona, California, Texas, Georgia, Florida, you're seeing them mostly come down and in some cases materially come down. And then it's being offset by other areas. So we're not seeing second waves. We're seeing like migration of big first waves. If you look at the curve in the Sun Belt, it looks like the epicenter, New York, New Jersey, Connecticut did in March and April, which are virtually down to zero. Schools are reopening. They just announced today in New York. It's been handled well. You're going to see the same thing start to happen in the Sun Belt. They're going to fall off the they're going to collapse the number of cases. And part of it is because of now people see it's real and they're using masks and they're social distancing, whereas in the beginning they don't. But I also think it actually hits a critical mass point where I think there's so many people that build antibodies when you hit such a high concentration that eventually the virus just has less hosts that it can get to. I mean, let's leave aside the health stuff. I'm a markets guy. It doesn't matter why they're coming down, but they are. And then we'll have a first wave probably in the Midwest, and cases will spike up, and they'll say, oh, it's a third wave. No, it's a first wave in the Midwest, and we'll deal with that. The good news is it's less population. The bad news is we'll have to deal with it. But by the time that happens, we'll probably either be at a vaccine or be at better treatments. The treatments just get better and better. Remdesivir cut a deal, I think, with Pfizer. They're going to produce tons of the remdesivir, a lot more than they thought they could, 2 million doses in the next few months. That was announced today. So the 5 key reasons that matter as to why the market's rallying, which was their question that they couldn't understand. Number 1 is earnings and estimates are blowing the doors off, okay? So now it's been, okay, this was Wednesday, 84% of the S&P had reported. I'm sorry, 63 had reported, and 84% had beat earnings estimates, which is the highest since FactSet even began collecting the data over 12 years ago. Record high beat rate. I think that's down to, it's now an 83% beat rate, but close to 90% of the S&P 500 has reported. So it's still the highest beat rate since they've been collecting data over 12 years ago. The source is FactSet from John Butter's report. This is huge. So expectations were very low. The bar was very low. It blew the door off. That's number 1. Number 2, for the first time since Q1 of 2018, and I covered this on the video, analysts are actually taking estimates up on a quarterly basis for Q3 and Q4, but more than that, for 2021, they've taken estimates up to over $165. They were down to $163 a few weeks ago, or last week. Now it's up to $165. And as I said, we haven't seen that since the beginning of 2018. That's really, really positive news, and it's catching a lot of people off guard. No one was looking at, with cases where they are, which is largely a function of testing going up. It went up 400% relative, from April 17th to July 17th, testing went up 400% relative to cases going up only 100%. But with that said, to see the jobs numbers like we saw today, which we're going to talk about a little later, and to see the earnings numbers and estimates. I mean, what's going to happen when there's actually a cure? With all the stimulus aid and liquidity and momentum we have going in, it's going to just be a very high growth. And by the way, I saw someone on, I don't remember the name, a couple days ago talking about, well, many people have been on talking about money supply growth of 25%. Mike Lee was out talking about that. But there was an economist on that said that usually you can translate about 1/4 of M2 growth into nominal GDP growth. So if we've had about 25% money supply growth since March, about 1/4 of that, call it 6.5%, would be an increase in nominal growth in the next year. So imagine if we saw 6.5% GDP growth for 2021, levels we've not seen in decades. That could just be staggering. So it was interesting to see it put in that context, because I think people were looking for 4 or 5% GDP growth next year. I think the Fed consensus was 5%. But what if we see 6.5%, 7%? No one is counting on that, and I think the market is really starting to sniff that out, which may give us gas in the short term to get the S&P to new highs alongside the NASDAQ, which would be pretty exciting. So number one was earnings and estimates exceeding expectations. Number two, economic data continues to beat expectations, and we saw that this morning. Blew the doors off with the jobs report. And this is the economic surprise index is still holding above 230. You haven't seen that ever. Okay, this is compliments of Ed Yardeni over at Yardeni.com. Put this out. So as of 2 days ago, it was at 218.9. The high peaks for the last 10 years through what was a bull market were 80 to 100. Now we're double that. The amount of data points beating expectations. So that's pretty exciting. The third reason the market's rallying is the stimulus aid and liquidity, over 10 trillion authorized. We haven't even used we've only used a very small portion of that. We're probably going to get more in this carve-out / deal / executive order, whatever comes of it over the next few days. But we haven't even used what we have. So this is going to continue to drive growth. And as the health situation is solved, this is going to be enormous for growth. And I think what's exciting about that is the structurally unemployed that really never benefited from the last recovery are going to finally start to benefit. They were starting to about 6 to 9 months before the COVID thing hit. These discouraged workers that are not even counted, U6 unemployment, they started to come back into the workforce, and we were seeing the labor force participation rate come back, which was really exciting because it affected a lot of people in their late 40s and mid 50s that still have room on their career, but were just kind of forced out, couldn't get back in, and now they're going to get forced back in as the demand for labor is going to go up dramatically with this level of stimulus, fiscal stimulus, which we've been waiting for years. The fourth reason is obviously the most important thing. We have good news coming out every day on the vaccine and treatment progress. And fifth, as I said, new cases are slowly coming down on the health front. Now, onto the shorter term view for the market. This week is amazing. Okay, new highs on the NASDAQ, markets moving up, and it's still the most hated, feared rally in history. You had the AAII sentiment survey results at 23% bullish. This is historically a pound the table buy level. When people are that scared and that fearful and skeptical, you want to be a buyer of stocks, not a seller. On the flip side, their bearishness was still up at 47%. Generally, when it gets into the mid-20s, you want to buy, and when it gets into the mid-40s, for bearishness, you want to be a buyer, and vice versa. When bullishness gets over 40%, you want to take a look at what's going on. We're getting a little frothier. You want to lighten up on some of your winners. We're nowhere near that, which is just staggering how much skepticism and it goes back to the Fidelity numbers, which said, I think it was like 60 it was some huge number. 60% of people sold at the bottom, or it was 30% of people over age 60 sold all their equity holdings at the bottom in March. So now they have to hate it because they sold at the bottom, and the higher it goes, they're going to get forced in against their will. So it's just it's frustrating to see, but you can't bet against America. It never ever pays. But nonetheless, there's still, look, everyone makes mistakes. There are still huge opportunities in certain sectors that have not rallied as much as the general market, which we've belabored in recent weeks, that you can still take tremendous advantage. I mean, you look at a company like follow Warren Buffett. Warren Buffett's buying Bank of America hand over fist. We like financials. Financials and defense stocks are still really, really cheap. Wells Fargo is still down over 50% off of its February highs. That's exciting. How many times in the last 4 decades have you had an opportunity to buy Wells Fargo at a 50% discount, one of the largest lenders in the greatest nation in the world, and trading at a 35% discount to book value? You have to believe, to think that this price is efficient, you have to believe that Wells Fargo is going to do half as many loans in the next 12 months as they did in 2019. With the asset cap on, by the way. They had the asset cap on in 2019, so the asset cap is not the only problem. And I think that's a sucker's bet, because you see it in housing demand, okay? Mortgages are going crazy. So there is abundant opportunity still out there where you can do even better than you would have if you just held the general indices through the downturn. And look, this is our opinion. You have to know your own risk tolerance, talk to your advisors, et cetera, et cetera. But these are just things we see based on a lot of experience and seeing a lot of cycles and studying a lot of history. So take it for what it's worth. Now, next, the fear and greed index on the flip side is showing a little bit, it's getting a little bit more greedy. So when I did this article, it was at 70. I think it probably closed today around 72, 73. In the area of 80 to 100 is when we want to start to get a little cautious, maybe trim some winners, maybe rotate from some leaders to some laggards, be more cautious. So we're keeping an eye closer on this. So these are conflicting signals, which I've not seen often in my career, but we are seeing it now. And then finally, the institutionally active managers from the NAAIM were all in at 97.44%. That doesn't mean anything in isolation, because as you saw here in 2018, they got to 103%, and the market rallied another 4 or 5 months. And if you look at the 2013 to 2016 period, it kept hitting 90 and 100 and stayed pinned over and over and over. So these are generally better contraindicators when they collapse, and to be a buyer versus shorting when they're extended. Same thing with fear and greed. But you do pay attention when they get to these levels and look to see where the froth is. So we said that in our message for the week, that we acknowledge the divergence. However, we weren't uniformly at euphoric levels. Only the National Association of Active Investment Managers was at euphoric levels. So we're very constructive in the intermediate term. We'll take advantage of any additional buying opportunities in laggard cyclical names, which we did in spades with Wells Fargo in particular this week. And we'll use any pullbacks or corrections to add more in coming months in the summer and fall. But for now, it's time to like it and love it until the euphoria shows up uniformly across all metrics and it becomes time to trim some winners. So that's the article of the week. Next, we want to move on to Zero Hedge. Actually put out an article late this afternoon about consumer credit. What I loved about this, if you look, when consumer credit moves from such a fall, this is, you can see here in red, it just fell off a cliff in 2008 and 2009. Once it inverts off that bottom, is usually highly correlated with when the stock market starts to rally, and that's why I keep emphasizing the transmission mechanism of Wells Fargo as being one of the largest extenders of credit to Main Street. is that when the credit gets out there, you get the recovery. And you saw that this inflection from 2009 to 2010, and the market just took off and never looked back. We had the lowest read, obviously, in March, and that has just turned materially positive. So the last time that happened, where you had that inflection, was back in the last crisis, and you got that first big spike green, and it just took off after that. And we just got the first big spike green. So this could be very, very promising for what's happening with the consumer. And, you know, in the non-revolving monthly credit change is even bigger than the overall U.S. consumer credit monthly change. So I thought I would highlight that because that was really a positive thing. Okay, now we have to talk about the election as we're getting closer. I'm going to talk about this only on a markets level because that's what I care about. Political level, I really don't, that doesn't make me money. Political ideology, what makes me money is being right about the market, and I think that's why you're listening to this podcast and videocast. So everything I say, it's about doing well in the markets. It's not about what I think about who should win or why they should win. So I always look at election betting odds because I think where people put their money is a better indication of where their talk is about polls and opinions that are useless. So right now, the money is still betting against the current administration, which you never want to count out ever. But what I'm most interested in is a sweep, which I don't think will happen, but the election betting odds are indicating at this stage where it will. Now, I don't have the data from 2016 to see how far behind Trump was from Clinton in election betting odds. I would love to have that data. If anyone can get it for me, I'd be very, very grateful. And, you know, please send me an email and we'll figure out how to use that. But I do remember he was down materially. I'm not sure what the spread was at this point. I do know, you know, when he had that Billy Bush video 3 weeks before the election, he plummeted and then he rebounded in 3 weeks, never mind 3 months. So this is not that important right now, but we have to start to factor it in. So right now, the betting odds are saying that the administration would lose, the Republicans would lose the Senate, the Republicans would lose the House. That would be a real problem because then you could have a tax change that would, and we've covered in recent weeks, regardless of what party you're in, the best thing that can ever happen for the stock market is gridlock, okay? So if Trump won the election, you would want to see the Democrats maintain the House and whoever, you know, gets the Senate. Republicans or Democrats, it wouldn't matter. As long as you have the checks and balances. If Biden won the presidency, you would want to make sure the Republicans held the Senate. Those situations are bullish for the markets. If you get a blue wave or a red wave, that's a big problem. But let's talk about a blue wave because that's what the election betting odds are looking at right now. And we covered a few weeks ago, someone asked on Ask Me Anything, question was what would be the impact? And we referenced an article that did the math based on if you raise the corporate tax rate to the levels that are in Biden's plan that he's publicly stated, it would impact S&P earnings by about 20%, which would immediately devalue everyone's nest egg and retirement by about 20% following the 2 or 3 months after he was elected, because the market would start to discount the reduction in earnings as companies had to use more of their profits to pay tax. So after-tax earnings would be impacted, and the market is just a function of a multiple applied to the earnings power. And when you have more money going to tax and less going into investment, not only do you have less earnings, but you have a slower growth rate because the money that could go into R&D and building out new factories is also curtailed. So you not only lose 20% of earnings, but you'd have a slower growth rate, which would likely have a lower multiple, which means you could lose more than 20% in the stock market and in people's retirement accounts. So most people are logical, and even if they dislike an ideology, they tend to be rational and vote their pocketbook in retirement. Why? because they work their entire life to build it up, and they don't want to see it collapse 20 to 30% overnight. Now, you'll say, well, what are you talking about? We had one of the greatest economies ever in the 90s under the Clinton administration, and you're absolutely 100% right, except for the fact that you had the checks and balances. You had your gridlock, okay? You didn't have a clean sweep of Democrats. You had, Republicans to check some of the extreme ideologies of Republican policy and extreme ideologies of Democratic policy. So, by the way, for everyone listening to the podcast, we may run out of time. Just go to hedgefundtips.com. It'll be on the YouTube VideoCast. Fast forward to the 60-minute mark, and you'll catch the last few minutes on video and not miss a thing. But I'm going to try to get right down to it. But this is an important subject. Now, no one is covering one of the key things that's happening. One is you can't predict out this far because it wasn't useful in 2016. What we can predict is if it's a full sweep, it doesn't matter really who gets the presidency from a stock market point of view, so long as the Republicans hold the Senate. But if you got a blue sweep, you are going to get a big, people's retirement accounts are going to go down dramatically. And for a lot of people that are older, that they can never recover from that because it's not like they can restart. So hopefully logic will prevail, at least, keeping the Republicans in the Senate, and more likely, other things could happen. Now, there's one thing that everyone has been ignoring that I keep tweeting. No one likes it. No one retweets it. No one even knows what I'm talking about. But Kanye West has been slowly and surely getting on ballot by ballot. Wisconsin, Arkansas, New Jersey's in contention, Oklahoma, and submitted Missouri, Illinois, and he's going for Ohio, West Virginia. And if you notice, most of these are swing states. These are not like red states. These are swing states. And the thing about Kanye West is, like in some sense Donald Trump, everyone underestimates him. And obviously the media overplays, he has these episodes. Look, the guy became a billionaire selling sneakers. So I wouldn't underestimate him. And how it will play out is as he gets on more and more of these. By the way, this is just getting on the ballot. The other states, people can still write him in. But it's easier to check the box. And I think that there's a large enough constituency in the country that really likes him and admires what he's accomplished in business and what he's done with his church and different things, that they will go out, particularly the younger demographic, they will go out and they will vote for him in these swing states. And that could unintentionally sway a ton of electoral votes away from Biden and to Trump. If any objective analysis of this says that it will pull votes from the Democrat side and probably deliver it to Trump. Now, if you're a Democrat, in some sense that's bad news, but in other sense, you might think that's good news, because what it could do is it could bring a ton of people out to vote in these states that would not go out to vote for Biden because whether they're just not excited or they can't relate to him, they will go out to vote Kanye West, and then they'll wind up voting Democrat because they're pulling the votes from Biden, but they'll vote Democrat Senate and Democrat Congress. So you could have literally a surprise as Kanye gets on more and more of these ballots where Trump wins the presidency because he gains all the electoral votes in the swing states, but if the Republicans aren't careful, they will lose the Senate because Kanye will bring in a lot more Democratic votes or a lot younger people out to vote who wouldn't vote. Obviously, the Dems are going to get the House. That's kind of known. The Senate, it's a lot closer. The Republicans are, in theory, expected to retain it, but that could swing. Now, if Trump won the presidency and the Republicans lost the Senate and the House, that would be bullish because you have the checks and balances. I know Republicans are going to, email me and go crazy, like, what are you saying that would be bullish? It would be gridlock is bullish for the stock market. I don't care about political ideology. I care about making money as for this podcast, okay? Maybe one day I'll do a political one. Don't hold your breath, okay? So that would be bullish for the stock market. If Biden won the presidency and the Republicans held the Senate and the Democrats kept the House, that would be bullish for the stock market. The only thing that's bearish, where everyone's going to lose a lot of money, is a blue sweep. Why? It's because earnings are going to be reduced by 20%, which means the stock market is going to be reduced by at least that much to discount that, and then the slower growth rate will probably yield a lower multiple. So it could be 25-30% of people's retirement nest egg that they lose in perpetuity until there's a change in administration, maybe the midterms 2 years later. But that's what's going to happen. Do not underestimate the importance of this. And if you're a market participant, I don't care about political ideology, you need to follow what Kanye West is doing and not underestimate him, because the guy has accomplished a ton and he's serious about this and no one is paying attention. So this is the story. If there's any journalists watching this, this is the story to be covering for the election, and you're going to become, if you spot this and follow this story and no one else is paying attention, it's going to create a career. For a political reporter that gets this, it's going to make their whole career, and they're going to become the go-to election person in perpetuity. So I would strongly urge anyone listening to this in the media, pay close attention to this story, because this will be game-changing, and I think it's going to have the impact that I said. It's going to surprise in the executive branch, and it's also going to surprise in Congress. So if you're a Republican, it would be a positive surprise for the executive branch and maybe a negative surprise in the Senate. If you're a Democrat, it would be a positive surprise in Congress and maybe a negative surprise in the executive branch. Watch this. Okay, next. Last few things we want to cover: earnings. We did our sector earnings bottoms up on transports this week. In the last 60 days, 2021 earnings estimates were revised down modestly by about 3.27%, which is pretty amazing considering this is weighted with airlines. So that was really positive to see. Next was retail. Through the roof positive revisions. In the last 60 days, 2020 earnings have been revised up 38% for this group of top 30 weights. Pretty exceptional. Now, this is what I was talking about. This is the first time since early 2008, Q1 2018, since analysts are taking up 2021 earnings estimates. It's now at 165.68, and let me just scroll down to show you what that means. Remember, we hit 3,400 on the S&P off $163 of earnings last year. We're now above that, which is why some of those, tail end 3,700 calls from, Tom Lee's and the Goldman Sachs of the world might be within reach. I mean, those are pretty aggressive, but if these estimates keep going up and taking everyone by surprise, that could be very positive. Earnings this week, we're not going to cover a lot of it because we're already running over, but we know that they were great. Again, regional banks, home builders, all just crushing it this week. See if there are a couple others that I just want to, home builders, big beats. Let's see if there are any other majors that I want to cover here. All the headline ones you've already seen in the news. Wow, quite a few companies reported. Disney, the big news there is that Loeb's Third Point took a major position today, or disclosed it today. So people are big on Disney in the last 24 hours. Let me just make sure that there's no other ones. Again, LGI Homes crushed it. Home builders, regional banks. Just scroll through this earnings calendar and just see which sectors are crushing it, and it'll give you an indication as to where the puck is headed. Pretty exciting to see all around. Now, the data this week, we already covered the Economic Surprise Index, crushed. One thing I do want to cover is the rig count came down yet again. We're down to 176 oil rigs, 247 total rigs. The oil rigs are down from 1,400 in December 2014. So we're going to wake up, I don't know if it's 3 months from now or 9 months from now, and oil prices are going to be $60, $70 a barrel. There's been no major investment in the last 5 years. You've got these OPEC cuts now that are kicking in, and we saw today that compliance is getting better because Iraq, who hadn't been complying, and that other nations have had to make it up, is now committed to doing 400,000 barrels a day in August and September. Just to remind you, because no one talks about it, this is a deal that started at 9.7 million barrels a day. It'll go down to 7.7 million this month until the end of the year. And then they're going to do 5.7 million barrels a day cuts from January 2021 through April of 2022. Never before have we seen this long-tailed of a cut plan. You have that coupled with no investment, coupled with the rig count down. It's just a formula, and then you're going to have a weaker dollar. After a bounce here, because everyone now is looking for a weaker dollar after it's already moved. So bounce and then a rollover. But all these things are pointing for huge rebounds for the left for dead energy stock. But you got to take a more than 3-week view. You got to take a 3-year view, and that's where your fortunes are going to be made in the right companies. Obviously, you got to go really high up the food chain because a lot more are going to go bankrupt on the low end. But really interesting to see that. As far as the jobs today, I'm not going to spend a lot of time on it. That's on every major thing. But non-farm payrolls increased by 1.76 million relative to 1.6 expectations. The other thing that was really good to see, average hourly weekly hours went up materially from it went up a little bit more than last week, so that's good to see. Not materially, but they beat expectations. Average hourly earnings went up. It jumped from up 4.1% to up 4.8%. And the U6 unemployment rate, the discouraged workers, that unemployment rate dropped a full 1.5 points, and the total unemployment rate dropped down to 10.2. If you remember, in March or April, I think I said by the end of the year we could see the unemployment. I know unemployment was at over 14% at the time. I said we're going to see high single digit unemployment rate before the end of the year, and we're literally now 20 basis points away. So that was a lot faster than expected. I don't think anyone was expecting it that fast. Other important data for this week, we saw the continuing claims drop. Again, beat expectations from 16.7 million. It came in at 16.1. That was huge. The initial jobless claims also plummeted. Came in at 1.1 versus 1.4 expected yesterday. That was huge. Another week of huge draws, which we covered last month. We put out the chart of when we'd move from surplus to deficit, and that's right on schedule. We're just crushing it. Last week was negative 10 million barrels, crossed expectations. This week is negative 7. Just watch the oil story. I know it's been long time coming, and everyone is still skeptical about it. It's going to happen. And non-manufacturing PMI crushed it. Services PMI. I mean, even Chinese PMI and EU PMI earlier in the week crushed it. So we're just seeing it globally. The recovery is happening. It is a V-shaped recovery. We got to get the health thing, but we've got so many shots on goal, as Dr. Fauci would say, and now some of these are starting to hit. And I think that's it on that side. Last thing we need to cover is the Ask Me Anything for the week. And this is kind of a tough question. This came from a gentleman named Ben who's asked questions before. I'm going to cover it just because I will, but I want to just get to the heart of it, because there may be some, kind of new traders and investors that are just watching this for the first time, and you probably have similar questions to this one. And I'm going to encourage you to learn from this. So he asked a good question. Ben says, if one's looking to short an index during a short squeeze, is it true that you'll probably get a better price during regular hours as opposed to pre-market, since they'll want to squeeze the regular stockholders in addition to the put option holders? So I think Ben's a little confused here. Number one, short squeezes are caused when you have a huge short interest that is unwound by an unexpected positive catalyst, and then you deal with the days to cover ratio. Can they find enough stock to buy back? Oftentimes they're all scrambling for the same stock to buy, and that's what you see these 10, 20, 30% jumps as the start of a new rally. The S&P is much more liquid than that, so I wouldn't look at it in those terms. As far as pre-market, institutions generally don't trade pre-market, so that's just like light volume trading. That is noise. I wouldn't pay close attention. And you never want to short anything during a short squeeze because you'll get your face ripped off. When you want to short things that you have a fundamental thesis are overvalued is when no one else sees it, or after the short squeeze, when the short interest has dramatically come down, the stock is up, everyone forgot about shorting it, but your thesis is still intact, why it's overvalued or why something's going to cause it to, collapse. That's when you want to short it, when the short interest is low, not when the short interest is high, because that's when you get your face ripped off because you're scrambling, it's crowded with everyone else. If you want a story on that, just take a look at Tesla stock. He's got the same, group of people have been pounding the hell out of it, and eventually they'll be right. They just won't be in the stock short anymore because they've lost all their money. So you have to be careful. You don't want to short the high interest stocks. You want to do your homework and short those stocks that don't have a high short interest, and ideally ones that did have a high short interest. The shorts got their faces ripped off. They've forgotten about it. They've moved on, but nothing's changed in the thesis that made you want to be short it when everyone else was there, and then you get in and you be patient. Second question for AM Ask Me Anything from Ben. It only takes two major players to run up or down the overnight futures when volume is light. Please explain how this stops out put or call option holders. I don't think it does. I mean, why would you? Unless you have a stop loss on an option, which that right there is a big warning signal that a person is probably not very experienced trading options to put a stop loss on an option. But how you manage risk in options is your sizing, not a stop loss. But leaving that aside, there are other people that maybe do it that way very successfully. So there are many paths to the top of the mountain. None's right or wrong. You just have to do the one that best suits your personality and works. So I wouldn't. Number one, your premise of two major players running it up when the volume's light. Okay, you certainly, there have been studies about the percentage of performance that comes overnight, and that is empirical and that is true. Whether it stops out option holders or not, if you're in options, you should have a clear view and manage risk through sizing versus a 20% stop or something. And you don't want market makers seeing your open stop orders. They'll just take them out. That's the whole Robin Hood game, right? Why are trades free? It's because they show the order flow and then they rip your face off. But leaving that aside, what I wanted to get to is the theme of the questions that Ben asked, and they come from a real base of intelligence. So I give you credit for thinking outside of the box. But what I'm seeing under the surface of the nature of the questions is a very short-term mindset trying to game short-term moves. And that's just a formula over time that you'll lose far more often than you win. That's not to say there aren't institutional guys who are very experienced and that have much better information flow that can do it on a very, very short-term basis. But if you're new in the game and you're trying to play these very short-term fluctuations, it's probably not going to end well over time. It's like you can walk into the casino. By the way, we were in Atlantic City last weekend, the Ocean Casino, which is phenomenal, by the way. I actually felt like I was in Vegas. It was so spectacular. It was packed. So when you see these economic data beats, number one, everyone was wearing masks and following the rules. They had all the plexiglass. Number two, it was absolutely packed. And it was really exciting to see that type of activity in the economy. The other thing that I found really interesting about that trip, this is a side note, is that that casino was built for $2.4 billion, and some group picked it up a couple years ago for $200 million. And it just goes to show where their opportunity is, number one. Number two, Bally's, which was owned by Caesars apparently, just was sold by Caesars to raise cash to a hedge fund guy for about $25 million. And when you see these buildings, I know Atlantic City, and I know online gaming, and I know all that stuff, but the value, and everyone's initial thing is, you don't want to buy anything in AC, it's all going online, blah, blah, blah. And these guys are going to make absolutely fortunes. And the analogy is, it feels like banks right now. No one wants banks. They're trading at a huge discount to their intrinsic value. They're out of favor. And sure enough, Buffett's buying it hand over fist. So with that, I want to wrap it up for the week. Thanks, Ben, for the great Ask Me Anything questions. If you have a question for next week, email it to me during the week, and we'll try to include as many of them as we can. So coming off a great week, let's make it another great one moving forward. And thanks for listening in to Hedge Fund Tips with Tom Hayes this week. Bye-bye.